We are ready to go here at Kravitz headquarters in beautiful, sunny Southern California. For those of you who don't know me, my name is Martha Ophir. I'm the marketing manager here at Kravitz. I've had the privilege of working with many of you through the Cash Balance Coach program and other Kravitz marketing and educational initiatives. I will be moderating here and perhaps sharing some of your questions with Dan, our cash balance expert. If you don't know Dan Kravitz, he is one of America's foremost authorities on cash balance plan, now a proud member of the Ascensus family. And he has worked with thousands of business owners, corporations, pass-through entities of all sizes on designing, implementing, and managing successful tax-efficient retirement plans. And the topic, as you know, highly anticipated piece of legislation. All of us in the industry were wondering how this was going to impact tax incentives for plan sponsors and for people who work in the industry as financial advisors. Dan, I remember, was waiting on the edge of his seat for this bill to drop and then almost, I believe, pulled an all-nighter reading every aspect of it, and then has spent the past month working with our actuaries, some of the tax advisors we work with, some of our industry experts, our lobbyists in Washington, just getting his head around everything relating to how this plan impacts the retirement industry. So we're very, very excited to share that with you today. Very quick housekeeping items. This is being recorded. You will automatically get the replay link within 5 business days. We will try to get to some of your questions. If we don't, we will reach out to you afterwards. The handouts are available there in your control panel. That is all 45 slides. You can print those out and take notes and go back to them. And your phone lines are muted, so you'll need to use the chat box or the question box to ask us questions. And Dan, you can take it away.
Great. Thanks, Martha. So real quickly on today's agenda, what we first need to do as retirement plan professionals in order to understand these new rules is better understand tax deductions. So I'm going to spend time on that topic. We're also going to need to understand how our clients as small business owners structure their businesses. So we'll look at that. Then we'll get into how the new rules work. Most importantly, I'm going to spend a lot of time going through some case studies, specifically, how these new tax rules interplay with the retirement plans that we set up for our clients as retirement plan professionals and financial advisors. And last but not least, we're going to finish with some conclusions. We're going to go out on a limb and make some predictions. And then, like Martha said, if we have time, we'll try to get to some of the questions. If we don't get to your question at the end of the presentation, we'll try to reach out to those of you where we didn't get to your Q&A.
So just a reminder, we are not tax professionals here. We are definitely retirement plan geniuses, actuaries, all kinds of experts, but we cannot give any professional tax advice. So please consult with your CPA, tax advisor, to review specific cases. And again, our focus here is just helping you understand what this all means for the retirement industry and for qualified plans.
Yeah, in fact, financial advisors and retirement plan professionals, I would look at this as an opportunity to partner with your client's tax advisor to help your client make a good decision. I think this is going to be a great opportunity as we walk you through this to add value. But no doubt, we're retirement plan professionals. A lot of us are financial advisors. This is not our core expertise. So make sure you partner with experts to better service your clients. So first off, we need to understand this new tax law, H.R. 1. In fact, just the name of it, Martha, has some interesting controversy. H.R. 1 is also called the Tax Cut and Jobs Act, but no doubt our president wanted to call it the Cut Act.
Right. So H.R. 1, not quite as sexy, but the content's very interesting nonetheless.
Yeah. So we won't call it the Cut Act. That's just too much of a mouthful. We'll refer to it as H.R. 1. But when you look at the rules and you peel it back, there are some key changes impacting small business owners. And no doubt, a lot of you that are listening in, you might be a small business owners, but if you're an advisor, you're probably partnering with small business owners to set up these retirement plans. So when we look at the new HR1 and we look how it impacts small business owners, there's a change to tax treatment to pass-through entities. What are pass-through entities? I'll get to that. But most small business owners organize their companies as a pass-through entity. So for some of these pass-through entity business owners, they can now deduct up to 20% of their qualified business income. And I'm going to call it QBI in this presentation, and we'll define that in a little bit. However, this new 20% deduction is subject to limitations and phase-outs. The top marginal individual rate was lowered in HR1 from 39.6% to 37%. Why is that important? Because our small business owners, pass-through entities, are not taxed at the corporate level. They're taxed at the individual level. So it's important that we better understand these new individual rates. But the result is, as a result of that small reduction to individual rates, as a result of this new tax deduction, many of our clients will have a lower effective tax rate, which may impact their decision on how much they contribute to their plans and also on the design of their retirement plans. And so we want to get into that. I also want to point out, and this is really important, we're still waiting on IRS guidance for many unanswered questions. So there is a possibility that what we discussed today could change once we get IRS guidance. Okay, so the first thing I want to do is take a step back and understand tax deductions. And when we talk about tax deductions, we talk about something called above-the-line deductions. This is the gold standard, the most desirable type of tax deduction. So contributions to a retirement plan or a cash balance plan is an above-the-line deduction. It reduces your AGI. That's the best type of tax deduction, much better than below-the-line deductions, which are subject to limitations and to phase-outs. For example, making charitable contributions is a below-the-line deduction. Paying your state taxes, property taxes.
And Dan, one thing we want to point out here is some of these deductions are lower now. So that is definitely something, the value of these below the line deductions is even less than it used to be before.
That is absolutely true. But now there's a new deduction, a new below the line deduction, and that's this new 20% pass-through deduction. In fact, I'm going to call it for this presentation a 20% pass-through deduction. Some people call it the Section 199A deduction because a new code section was added. And it's code section 199A. But these below-the-line deductions, are not nearly as valuable as an above-the-line. They don't reduce your AGI. They're subject to all sorts of limitations and phase-outs. In fact, as I've heard people talk about this new 20% deduction, some people call it a between-the-line deduction. So why would you call it a between-the-line deduction? Again, it doesn't show up on page 1 of your 1040, doesn't reduce your AGI like a contribution to a retirement plan, but we're not expecting that you're going to itemize it on a Schedule A like other below-the-line tax deductions. That's why, our expectation is that it might show up on page 2 of the 1040, and that's why some people are calling it a between-the-line deduction. But one important thing that I want to point out that a lot of people quickly realize is that this is not likely to reduce our clients' state taxes because of the way it's going to interplay with most state taxes.
And cash balance plans tend to be heavily concentrated in states with high state tax rates.
Yeah, absolutely. So thanks, Martha. So these next 2 slides, if you get anything out of my description of the new rule, I'm going to summarize it on slide 8 and 9. Then I'm going to go into more detail later. If you get a little confused as I go through the detail, go back and look at slide 8 and 9 in your handout. I really want you to understand this part of it. What we want to know is who qualifies for the new 20% deduction. Basically, any business owner of a pass-through entity in any type of profession who has income below a specified threshold. And that threshold is $157,500 for single filers, $350,000 for married filers filing jointly. Now, by the way, as I go through this presentation, I'm just going to stick to the threshold for married filers, just because it's too much of a mouthful for me to keep saying $157,500.
And not that Kravitz is trying to push the marriage issue here. We don't believe everyone needs to be married, but the vast majority of our clients fall into the category of married filing jointly. So that's the way we're going to refer to this.
Yeah, and what's kind of interesting here, when you think about this, if you have two business owners, you have two clients earning have taxable income of $250,000 doing the same thing. One of them's single and one of them's married. Only that married one under this, based on what I just read, would qualify for the new deduction.
So somebody may be getting a ring this year, is what we're saying.
Also in the law, not in Section 199A, by the way, there's this controversy about whether or not you can still deduct your alimony. So after this year, you'll no longer be able to deduct alimony payments. So I know there's a lot of rush for people to rush in their divorces this time of year.
There's not.
but hold off. You would lose the ability to possibly get this new deduction. In addition to business owners below that threshold, also business owners of pass-through entities that are not specified service firms but have incomes above the threshold also qualify for this new deduction.
And we're going to get into the details of what that specified service firm means very shortly.
Yeah, absolutely. And that's going to be critical. However, the deduction for these individuals is subject to limitations. So just to repeat, this is really important. Any business owner of a pass-through entity that has taxable income below the threshold, married $315,000, is eligible for the deduction. If you're a business owner of a pass-through entity that's not a specified service firm, which we'll define later, you're above the threshold, you're eligible, but you're subject to limitation. So who does not qualify for the deduction? Well, business owners of pass-through entities that are specified service businesses and have taxable income above $207,500 if single, $415,000 married filing jointly. By the way, these are adjusted for inflation. And when we did, as many of you know that work with Kravitz, we work with a lot of plan sponsors that have cash balance plans. We went through the few thousand clients that we help, and this represents 80% of our clients. And I'm sure that's true for a lot of retirement plan professionals and financial advisors that are working with high net worth individuals that sponsor these sophisticated plans. For the most part, under the current rules, they're not eligible for the tax deduction. So again, I'm going to go into more detail in a little bit, but slide 8 and 9 is something I really want you to understand.
Dan, a quick question that came up was, does this 20% deduction, does this new rule expire the way some of the other new deductions do?
Good question, Martha. So yes, it does expire. And so this is going to expire after December 31st, 2025.
Unless it gets renewed, obviously.
Correct. Okay, so we talked a little bit about deductions. Now let's talk about business structures. And this is going to be important. We need to understand better how our clients structure their businesses. And so for most small business owners, for most of our clients, they're structured as pass-through entities. And in pass-through entities, profits are passed through to the owners and taxed at individual rates rather than at corporate rates. So some examples of pass-through entities are sole proprietorships, partnerships, S corporations, limited liability companies. This represents the majority of small business owners. This represents the majority of our clients, and I'm guessing you that are listening, your clients as well.
Dan, would it be fair to say just over 80% of Kravitz clients would be pass-through entities?
Yeah, and most plan sponsors are small businesses, so I'm guessing it's the same for everyone listening in. Now, a business structure that is not a pass-through entity are C corporations. This is the most common type of corporation that people think of. It's the Fortune 500 companies for the most part. The corporate tax rate dropped from 35% to 21%, but remember, income is taxed twice with regards to, for most owners of C corporations. It's taxed at the corporate level, and then it's taxed again at the individual level. Because most of our clients are not C corporations, they're pass-through entities, we're going to spend the remainder of our presentation focusing on the new rules that affect the pass-through entities. But there's no doubt because the tax rate dropped from 35% to 21%, I know a lot of tax experts are now reevaluating for some people, whether or not it makes sense to stay as a pass-through entity or convert to a C corporation. That's above my pay grade, but no doubt that's something for some people.
And generally, the interpretation we've heard is that the government created this pass-through deduction so that those smaller businesses that are pass-throughs are not being disadvantaged by this new 21% rate.
That's absolutely correct. Okay, so we talked a little bit about tax deductions. We talked a little bit about how our clients structure their businesses. Now let's get to how the new rules work. Okay, when we look at H.R. 1, we need to understand now something called a specified service, trade, or business. And by the way, you do not, for purposes of getting this tax deduction, you do not want to be a specified service, trade, or business. A specified service, trade, or business is any business involving the performance of services in the fields of health, law, accounting, actuarial science, oops, it caught us, Martha, performing arts, consulting, athletics, financial services, sorry, you financial advisors that are listening in, brokerage services, or, get this, any trade or business where the principal asset of such trade or business is the reputation or skill or one or more of its employees or owners.
And that actually sounds very open-ended, Dan. I think it's a concern we've heard from some of the people we work with and plan sponsors is what does that really mean, this reputation or skill? It seems like that's a basket that would include a lot of companies.
Yeah, that's definitely the way, it reads. We're expecting that IRS is going to issue guidance on this. And the rumor is that they're going to likely narrow this a little bit. So no doubt if you perform the services in the fields listed, in the first part of this sentence, you're probably, not going to be able to easily take advantage of this rule. But expect guidance on that shortly. And we're expecting it to narrow. In addition, it also includes performance of services that are really in the investment management business. Sure looks, when I read this, they're really trying to make sure that financial advisors do not benefit from this new rule. A real simple definition that I've heard is, at the end of the day, if the success of your business depends on you and not on the items you sell or produce, you're likely going to be a specified service business. And last but not least, there's a special exemption for engineers and architects. So, for financial advisors, actuaries, our lobbyists clearly are not as good as the lobbyists that work for engineers and architects because we did not get a special exemption written into the bill like they did. And by the way, this is where there's a lot of opportunity where we're seeing a lot of tax advisors consult with our clients about how to maybe reclassify some of their income as not being performance of services in these fields, but maybe as, producing or making something in order to get some of your income to qualify for the new deduction. Again, above my pay grade, but just know that conversation is going on out there, and no doubt IRS guidance will probably come forth. So, when you look at H.R. 1 and look at this new code section, you also need to understand what is qualified business income, or QBI. QBI is defined as the net income from your business, not including reasonable compensation. So, for example, for partners of a partnership that report their income on a K-1, and we look at their earned income, it excludes guaranteed payments. So I've heard a lot of people talk to, let's say law firm partners to maybe rethink the way they classify their income. You might not want to show your income as guaranteed payments. S corporations. We all know S corporations, show their income as both on K-1s as earned income and W-2 wages. The income shown on a W-2 is excluded for purposes of S corp owners. The K-1 income would qualify as QBI.
And Dan, traditionally, our S corp clients have tried to keep those W-2 wages on the low side. Is that it needs to be reasonable, but they want to keep it low?
Yeah, it definitely needs to be reasonable. Historically, even before this new rule, our clients try to keep their W-2 wages low to avoid paying payroll taxes on their income. In fact, oftentimes we have to work with our clients and encourage them to show more W-2 wages because when we do testing in retirement plans, we need higher W-2 wages. But now as a result of this new rule, there's even more of an incentive for S-Corp owners to reduce the amount of income that they show on a W-2 as opposed to a K-1. Again, I would expect some additional guidance here, but that reasonable compensation rule is something we need to pay attention to. So basically, QBI is ordinary non-investment income net of ordinary business expenses. It's determined at the business level, not at the taxpayer level. But also, you must know is that the 20% deduction of QBI for pass-through business owners also cannot exceed 20% of your total taxable income, less net capital gains. I know that's confusing, so we're going to look at some examples. So let's say we have a small engineering firm set up as an S corporation. Qualified business income is $100,000. W-2 wages is $150,000. Our owner's Susan. She's married. She has taxable income. Her and her spouse have total taxable income of $300,000. So is Susan eligible for this new deduction? Well, first off, she's part, her lobbyist, she's an engineer. They have really good lobbyists. So they're exempt from being a specified service. But even if she wasn't, her taxable income, her and her spouse's taxable income is below $315,000, below the threshold. So even if Susan was a lawyer or doctor, she would still be eligible for this deduction. So now that we know Susan qualifies, what's the deduction? Well, we know her QBI is $100,000. W-2 wages is $150,000. Total taxable income is $300,000. What's her deduction? Well, 20% of her QBI is $20,000, 20% of $100,000. 20% of her taxable income is $60,000. The lesser of those two amounts is the deduction. So her 20% deduction is $20,000. Okay, let's go through some more. Now I went through that example. Let's look at this threshold a little more deeply. So as we've talked about it, the full 20% deduction is available to pass-through business owners with total taxable income below that threshold amount. Again, that threshold amount is $315,000 for married taxpayers filing jointly. For business owners with taxable income above the threshold, a wage and capital limit applies. However, for specified service businesses, financial advisors, lawyers, doctors, owners with incomes above the threshold, the 20% deduction phases out. And after a phase-out limit, they're completely excluded from the deduction. Let's look at this. Let's look at this phase-out for our lawyers, doctors, and financial advisors. The 20% pass-through deduction is phased out or proportionally reduced when their taxable income exceeds that threshold, $315,000 if they're married. I'm sorry, let me just rephrase that. It's proportionally reduced between $315,000 and a phase-out limit. The phase-out limit is $415,000 if married filing jointly. So again, when taxable incomes are in this phase-out range, when it's between $315,000 and $415,000, the deduction decreases as income increases. When taxable income exceeds the phase-out, the deduction is completely eliminated. So again, it's worth repeating, and I just want to pause here for a minute. For specified service companies, lawyers, doctors, actuaries, financial advisors, if your income's below $315,000, you get the deduction. Between $315,000 and $415,000, it starts to phase out. Above $415,000, you're not eligible for this new tax deduction.
And Dan, just because this terminology around the phase-out limit and the thresholds, the numbers, it can get kind of confusing. Would you just reiterate for everyone what's the essence that they need to understand of this? Because this is really getting into the weeds here.
Yeah. At the end of the day, just focus on the fact that, if you're a specified service business and you're a high earner, you're not going to be eligible for the deduction. On the other hand, if you're not a specified service business, you will be eligible for the deduction. But once you start to make above $415,000, some new limitations will apply. Speaking of limitations, there's this wage and capital limitation that we need to understand. And basically what it says is when taxable income exceeds the threshold, when it exceeds $315,000, the 20% deduction is reduced based on this wage and capital limit. Okay. Now follow me. This is when it gets a little confusing, if it's not
very confusing.
Or very confusing. Let's look at this, how this wage and capital limit is calculated. Okay. It's the greater of 50% of your share of the W-2 wages paid by your business. So if you look at that, the more your business has in payroll, the higher the limit is. And it's half of that. Or 25% of the W-2 wages plus 2.5% of the capital assets used in the production of income. It's defined as qualified property. So it's the greater of these two amounts. Some of our business owners, if they make more than 315, are going to be subject to this wage and capital limit. If the results of that calculation, 50% of your W-2 wages or 25% of W-2 plus 2.5% of capital assets, the greater of, is less than 20% of your QBI, your allowable pass-through deduction is proportionately reduced.
And you don't really have to remember any of this unless you're a tax advisor.
Yeah. Again, I'm starting to get into the weeds here. Again, go back to slide 8 and 9. If you're getting a little confused, particularly if this is your first time looking at this, you probably are a bit confused. Go back to slide 8 and 9. But basically, if taxable income exceeds $415,000 for our married business owners, your pass-through deduction cannot exceed the lesser of 20% of QBI or the wage and capital limit. So now that was a little confusing, Martha, so let's take everyone through some examples. Oh, before I do that, let me take a step back. We need to define qualified property. Qualified property refers to as tangible items such as equipment, furniture, computers, vehicles that are subject to depreciation and are used in generating qualified business income. The qualified property must be available for use in your business at the end of the tax year. Okay, now let's go to some examples. So let's say, for example, we have an S corporation. It's a shoe manufacturer.
There are some in America. I believe there's 3.
and our shoe manufacturer is, as we know, is not a specified service business. Okay. So when we look at our shoe manufacturer, it's a successful business. They're selling a lot of shoes, and their total qualified business income is $1 million. They have a lot of employees. So when you look at the wages of the employees and the employee owners, total wages, total payroll is $700,000. There is no qualified property in this business. Alex is a 30% shareholder, and he's married. So he's one of the owners, and his total taxable income is $500,000. Clearly, the shoe business has been good to Alex. Okay, so what is Alex's 20% deduction? Well, remember, Alex only owns 30% of the shoe manufacturer. So when we take this $1 million of qualified business income, we allocate it based on ownership. So we allocate 30% of it to Alex, and he gets allocated $300,000. When we look at the wages of all the employees on payroll, again, Alex owns 30%, so we allocate 30% of the wages to Alex for the purposes of the calculation. 30% of $700,000 is $210,000. 20% of his QBI, 20% of $300,000 is $60,000. Half of the W-2 wages allocated to Alex, 50% of $210,000 is $105,000. And then we look at Alex's taxable income. Remember, Alex and his spouse had taxable income of $500,000. 20% of that is $100,000. Look at the last 3 lines. We take the lesser of these 3 numbers, and that's going to be Alex's tax deduction. So 20% of is 20% deduction, $60,000. I'm going to pause there. Just take a look at that for a second, and we're going to move on to another example. Okay. Now let's say this S corporation is a CPA firm. And it's Bob now. So Bob is a CPA. Bob also is a 30% shareholder. But as you know, a CPA firm is one of those specified service businesses. So same numbers, don't get caught up in all these numbers. Nothing's changed. We just took our shoe manufacturer and Alex, converted it to a specified service business, to a CPA firm. All you really need to focus on is the fact that Bob is an owner in a specified service business, and look at Bob's taxable income. Bob's taxable income is $500,000. That's all you really need to know. It exceeds the phase-out limit. And we know, unfortunately for Bob, because his taxable income is above $415,000, he's not eligible for this tax deduction. So he's not going to be eligible. I'm not going to do it, but if I was to do another example, instead of having Bob, I had Gary, and Gary's taxable income was not $500,000, but was $300,000, then he would be eligible for this deduction, and it would be $60,000.
And what we're going to show you in a minute is how qualified retirement plans can make those who are maybe not eligible become eligible for this 20% deduction.
Yeah. So that was sort of our attempt to summarize this new code section 199A. We definitely simplified it. It's a little more, believe it or not, it's more complicated than what we just reviewed with you. There are other items that I left out that don't typically impact our clients. Again, I'm just going to say it one more time. If you found this confusing, go back, go through the handout, focus on slide 8 and 9. And for those of you that are geeks like me and want to go through the weeds of the calculation, then look at slides 10 through 28. Okay? But I really want to get to the heart of our presentation now, and that's why I kind of rushed through those first 20 slides, is we want to now look at some case studies and talk a little bit about how this new code section 199A impacts the retirement plans that we as retirement plan professionals set up for our clients. So let's look at a typical case study. And let's say it's a typical small business. It's an S corporation. It's a medical group. So we know a medical group is going to be one of those nasty specified service businesses. Our owner is Dr. Marshall. Dr. Marshall is 61 years old. Compensation is $275,000. Those of you that work in the field know that his income could be higher than $275,000 for purposes of retirement plan calculations. The government caps compensation at that amount. And Dr. Marshall has 4 employees. And there you can see his 4 employees, their ages, and salaries. And last year, back in 2017, Dr. Marshall met with one of our Kravitz consultants, met with a financial advisor, and decided it might make sense to set up a retirement plan. In fact, Dr. Marshall actually did quite well, was having a really good year, has a lot of disposable income, and he really wanted to supercharge his retirement program. So he decided to adopt both a 401k profit sharing plan and adopt a cash balance plan. For those of you that work with Kravitz, you're probably familiar with the way we present our illustrations. So this is a very common illustration, but I'll kind of walk you through it. Up on top, you can see our owner, Dr. Marshall, 61 years old, with salary of $275,000. And in blue, you can see within the 401k profit sharing plan, he's over 50, so he gets to contribute $24,500 to the 401k plan. For testing reasons, doesn't quite get the maximum profit sharing contribution, but he's able to make somewhat of a profit sharing contribution to the plan. And then because of his age and because of the way cash balance plans work, we're able to put in a significant amount of money into a cash balance plan on behalf of Dr. Marshall, another $268,000. So when we add it all up, Dr. Marshall last year was able to put just north of $300,000 into his qualified plans. Now, in order to pass testing, and those of you that work with these programs will notice this right away, you have to make a profit sharing contribution to those 4 employees. And because of the way the discrimination testing works, most of our clients typically, to get the maximum cash balance contribution, have to make a profit sharing contribution of 7.5% of pay. In addition, due to other testing rules, we also have to make a small cash balance contribution to the employees. But when you add it all up, we're putting in, roughly $14,000 into the program for the 4 employees, but that buys, if you will, close to a $307,000 contribution for Dr. Marshall. So so Dr. Marshall, when you look at the bottom of this spreadsheet, 96% of the $321,000 going into the program is going in for Dr. Marshall. So we met with him in 2017. He was very excited about this program. Was able to defer a lot of money into a qualified plan, and we were able to significantly reduce.
And he still looks like a hero to his staff.
Yeah, absolutely. All the we're going to get to this later, but all the benefits of sponsoring a plan, besides what we're focusing on in this presentation, is the tax benefit. He's able to save a lot of money for his own retirement and create great wealth for his employees. Okay, but now we fast forward into 2018. So that was all fine and dandy for last year. So Dr. Marshall calls us up and he wants to know, he heard about this new cut act. See, I said it.
No, yeah.
he heard about HR1 and he heard there was a new code section 199A, but he's a smart doctor. And he asked us, should Dr. Marshall still contribute to the plans? Well, let's take a quick look. As we know, it's a medical practice. It's an S corporation. And we know his total taxable income is $650,000. So when we just look at this slide, we also learned that when taxable income for a specified service business, a medical practice is a specified service business, exceeds $415,000, he's not eligible for this new deduction. In fact, really, if we just pause here for a minute, all that really changed for Dr. Marshall and for a lot of our clients is his highest marginal federal rate dropped from 39.6% to 37%. So if I just kind of just looked at the fact pattern that I have so far, I would say, setting aside money in a retirement plan still makes a lot of sense. You're in the highest federal tax bracket.
He may be able to deduct less of his state and property taxes.
Yeah, so he might be looking for other ways to reduce his tax liability. So no doubt it still makes sense. But actually, I'm going to be able to show Dr. Marshall that the retirement programs that we set up for him in 2017, post-tax reform, are now even more tax efficient. The plans are even more beneficial. And let me show you why. So by contributing $335,000 or more to those retirement plans, we're actually able to reduce his tax liability even further. Even more so than we did in 2017, and we can drop it to 20%. Let's take a look.
Effective tax rate.
Thank you. So his taxable income, remember, was $650,000 before the plans. But if we contributed to both programs a total of $335,000, we can drop Dr. Marshall's total taxable income from $650,000 to $315,000. Remember, that was that magic threshold number. As a result of dropping his taxable income to $315,000, he is now eligible for that new deduction. So his 20% pass-through deduction is going to be $23,000. Basically, what we did was, remember, it's an S corp. W-2 compensation is not eligible for the deduction, but his K-1 income is QBI. It is eligible. So 20% of $115,000 is $23,000. So his taxable income is further reduced, not to $315,000, but to $292,000. So when we look at the new tax brackets and calculate his tax liability, it's roughly $59,000. So his effective tax rate is 20%. So again, to recap, the power of saving in a qualified plan in this scenario increases. In fact, this is so important, Martha. Let's look at this one more time for a financial advisor. Let's say we have an S corporation. It's financial services, so we know it's a specified service business. Our financial advisor is married. His or her W-2 compensation is $200,000. His or her QBI is $300,000. Total taxable income for our financial advisor is $500,000. It exceeds the $415,000 limit. So if this advisor doesn't do anything and stops there, they're not going to qualify for the 20% deduction, right? Specified service business above $415,000 does not get the new deduction. However, if this financial advisor decided to set up a cash balance plan, make a $185,000 cash balance contribution, we can drop his or her taxable income to $315,000, right? QBI also drops to 115, right? It drops from 300 to 115, but now he or she is eligible for the deduction. So his or her deduction increases from $0 to $23,000. And the net taxable income drops to not to 315, but to $292,000. So in effect, this $185,000 contribution creates a $208,000 reduction in taxable income. Let me pause there. For those of you that are retirement plan professionals, financial advisors, take this in. Contributing to, in these scenarios that I'm walking you through, the power of saving in a qualified plan in terms of the power of the tax efficiency of the program increases.
And Dan, just to clarify, because we've had a couple of questions around this, is this not creating a situation where within one S Corp, for example, or partnership, each partner might have, some partners might be eligible for the tax deduction and have this increased incentive, and some might not?
Yeah, you definitely, absolutely right, Martha. You can have two partners, doing the exact same thing.
Same QBI.
Same QBI, same W-2, but their taxable income could be different. Or one could be married, one could be single. You can see how, every situation is unique. And again, when I get to my conclusions and predictions, I really think this is a great opportunity for us that are retirement plan professionals, for financial advisors to partner with our clients' tax professionals and look at this more deeply. Because no doubt it's going to vary depending on each person's situation.
And their situation could change year to year as well.
Yeah. So I just kind of walked you through when retirement plans make even more sense after the new law. But when might tax incentives for retirement contributions be reduced? So as a reminder, qualified retirement plan contributions are deducted against business income. They reduce QBI. And some owners, may be taxed at a lower rate than the individual tax rate they might pay when withdrawing money from their retirement plan, right? Because as we know, unfortunately, the 20% deduction is not available to business income deferred in a qualified plan. I know our lobbyists were working really hard to try to accomplish just that and to see if there was a way to make that income that's deferred for business owners to qualify, but unfortunately we were not successful. And so in my opinion, what now needs to be done for these individuals, and these are, the widget makers, these are people with incomes below 315. They now need to weigh this 20% deduction against the power of saving in a tax-deferred vehicle. And you really need to do a plan versus no plan analysis. Compare the tax deferral in a plan versus the 20% deduction. I've listened to some presentations where people have walked people through that. I would argue there are so many variables. You can get that plan, depending on the situation, it can vary significantly. No doubt, oftentimes the plan wins, but not in every case.
And Dan, if I'm a plan sponsor, how do I get a plan versus no plan analysis? Or I guess not on the plan level, but on the individual level?
Yeah. So I would encourage, if you're a small business owner and you're listening to this presentation, first, good for you for trying to understand these new rules. I would definitely contact your tax advisor, contact your financial advisor, and definitely sit down with the team. Really, we need to work as a team now to understand how these plans interact with this new Section 199A rule. Okay. So let's look at a case study, where, if you will, you might try to make this decision of deferring money and not get this deduction. So let's say, for example, we have an S Corp owner, an owner-only S Corp, and they have no plan. Maria, in this case study, our business owner is Maria. So Maria has taxable income of $275,000 below the 315 threshold. Her QBI is $150,000. Maria's W-2 wages is $100,000, and she has a miscellaneous income of $25,000. Without the plan, her 20% deduction is 20% of the QBI, or $30,000. Okay, her net taxable income is $245,000. So good for Maria. If she doesn't have a plan, at least this new tax deduction was able to reduce her taxable income from $275,000 to $245,000. Okay, but let's say she decides to adopt a retirement plan. Let's say she adopts a profit sharing or maybe she adopts a cash balance plan. Either way. And let's say her total plan contribution is $60,000. So by making a $60,000 contribution to a qualified plan, we're going to reduce her taxable income from $275,000 to $215,000. That's a good thing. But her QBI is also going to be reduced. Remember, she had $150,000 of QBI. That's going to come. The $60,000 contribution is going to reduce that. So her 20% deduction is going to be reduced to $18,000. So it gets reduced from $30,000 to $18,000. What should she do? Well, her net taxable income gets reduced to $197,000, right? $215,000 minus the $18,000. So her taxable income without the plan is $245,000. Her taxable income with the plan is $197,000. So in effect, there's a $48,000 reduction in taxable income with the plan. Remember, she made a $60,000 contribution, but because of the way this works with this new rule that she's eligible for, it only reduces her taxable income by $48,000. So the $60,000 contribution, when it's taxed at withdrawal, when she takes the money out of the plan, does not get that 20% deduction. So the plan contribution is 80% deductible. Should she still contribute the $60,000 to the plan? I would argue likely yes, because that $60,000 will grow in a tax-deferred vehicle. And I think it's incumbent on us, on the financial advisors listening in, to sit down with Maria, maybe also get the tax advisor on the phone as well, and do a plan versus no plan analysis. It's really hard to predict all the different variables for Maria. The analysis that we did at our office, depending on how we set these variables, typically show the plan still makes a lot of sense. Okay. I know that was a little confusing. I know the handout is available. I would encourage people to go back, maybe listen to that portion of the webcast, look at those case studies. So now we're going to review some conclusions based on what we've seen and also make some predictions. So first off, I want to point out that the key incentives for sponsoring a retirement plan really hasn't changed, right? It's a great way to accelerate retirement savings. Here at Kravitz, we like to say by having a cash balance plan, for example, you can squeeze 20 years of savings into 10. Creditor protection is really important to our clients, particularly our medical groups.
About 30% of cash balance sponsors are in the medical field, and they're particularly vulnerable to lawsuits. So for our clients, it's a huge incentive to have that money protected.
Absolutely. You still need a retirement plan to attract and retain top talent. The contributions are deductible. And no doubt, we need, a lot of business owners are paternalistic, and they want to strengthen the financial wellness of the benefits for their employees. And last but not least, I'm a business owner. I'm terrible at saving. So it's kind of a forced savings for the business owner.
That's really important for you as financial advisors when you're doing the plan versus no plan, is get your client to be realistic. If this money is not put into a plan, is it going to be saved?
Okay. So, another conclusion. So changes to tax incentives are minimal for a lot of our clients, right? I think for a lot of our clients, particularly our high net worth individuals that are doctors and lawyers, for example, and I just use them as examples because a lot of cash balance plan sponsors are medical groups and law firms. It's about half of the plan sponsors. Really all they saw was a minimal change. Their highest marginal rate went from 39.6 to 37%. But there are some exceptions, for those non-service pass-through entities, for our Alex, our shoe manufacturer, for example, he now needs to weigh this new tax incentive and compare that to the power of deferring in a qualified plan. Also, service pass-through entities that are below the threshold, below $315,000. I think back to a lot of our clients when I think to, dentists versus cardiologists. A lot of our specialty medical doctors make well above the threshold. So, it's really a non-issue for them. But for, a dentist, for example, making $250,000 of taxable income, assuming he's married or she's married, there is some changes to the tax incentive for him or her. But as a reminder, and that's why I'm not walking you guys through a whole bunch of plan versus no plan analysis, because it's impossible to predict future tax rates. It's unwise to base retirement savings decisions on the assumption about your current tax rate, because it's likely to change. Effective tax rates have changed almost every decade since the 1930s, and I imagine that will change going forward.
Right. And some of these are going to sunset. There's a lot of variables.
Yeah. So some predictions. So I'll go out on a limb and make some predictions.
This is what Dan looks like when he makes his future predictions related to the retirement industry. There's a special hat. It gets really crazy here.
I think this is actually a picture of me after I tried to read H.R. 1.
This is true. Yeah.
Pulling an all-nighter trying to understand Section 199A. Yeah. Anyway, we digress. Most business owners will continue to adopt qualified plans. I don't think that will change. However, additional analysis will need to take place for some of those owners. For Alex, our shoe manufacturer, for example, or a dentist earning $250,000 and is married. Again, I probably said this too many times, but I just want to point out for those of you that are listening and that are retirement plan professionals or financial advisors or TPA, I think it's a great opportunity for you to consult. Partner with the tax advisor, because a lot of the analysis is kind of above our pay grade, or at least above my pay grade. Would want to better understand the implications from a tax perspective.
An issue we may have not highlighted enough is just that HR1 has impacted the deductibility of state and local taxes and property taxes, and that does impact a lot of our clients. And again, they create a greater incentive to increase qualified plan contributions.
Yeah, and no doubt during this 1 hour presentation, we've been just focusing on a specific section of the new rules, code section 199A. There's a lot more to this. And with just 1 hour, we decided to really focus on this because it seems to be the heart of what changed for a lot of our clients. And you could see small reductions to employer contributions. There might be some business owners who decide to pay the taxes today and take the deduction and not defer into a retirement plan because they could perceive that they're losing out on this 20% deduction. It's up to us as retirement plan professionals to make sure they understand the power of saving in a retirement plan. So some owners, that have a 401k profit sharing plan might opt to just make 401k contributions, or them and their employees just make 401k contributions. But then, as I showed in our medical group example, qualified retirement plans become even more tax efficient for many service business owners. So if you worked with Kravitz and you set up a retirement plan for a client before, there's a good chance that we might even want to increase the contributions to that program to get their taxable income below that threshold, and then the power of saving in a plan is even more impactful. Okay, so in terms of next steps, I would, again, consult with your tax advisor regarding your pass-through deduction eligibility, any changes to your business type. I heard some examples where people are definitely looking at the business structure, comparing the pass-through entity and this new deduction to C Corps and the lower tax rate. Usually, I think the pass-through entity still wins, if you will, because of the double taxation of C Corps. Ask your financial advisor for a plan versus no plan comparison. Consult with your Kravitz consultant on possible changes to your design. Again, we might want to increase contributions to the program if we can get you below the threshold. Those of you that haven't worked with Kravitz before, particularly if you're new to working with us and you haven't experienced cash balance plans, you're just working with 401k plans, sign up for our cash balance coach program. It's a great education training program. We have close to 1,700 alumni that have gone through the program. Great way to learn how to grow your 401k business. And definitely feel free to give us a call at 877-CB-PLANS and visit our website, cashbalancedesign.com. So I have about 4 minutes to go. We do have 1 million questions. So what I'm going to do, I'm not going to be able to get to all the questions. I'll peruse through some of them and see if the ones that I think might interest everybody, I'll go ahead and read and answer.
Well, Dan is scanning through the 150 questions here. I'll just tell you, I noticed that a lot of you submitted questions about changing entity type and specifics about nuances about who counts as a specified service firm specifics about the deductions. Again, to reiterate, we cannot answer those questions. We're not tax professionals and we can't advise you on any particular case. So we can really only answer general questions about retirement plan impact.
Yeah, it looks like I'm hearing that the sound, as I'm starting to look at the questions, and I apologize for not looking at them before. It looks like some people had sound issues. We actually recorded this on a different mic, so if the sound wasn't great, I apologize. Go back and listen to the recording. Hopefully the sound on the recording will be better, so I apologize about that. When I look at technical questions about the new rules, a lot of questions are coming in about asking me about different types of businesses and whether they're specified service businesses. I don't know. I don't know, and I think a lot of people are waiting for IRS guidance. So for those of you that are curious if different types of businesses are specified service businesses, I would suggest you go ahead and look at, wait for IRS guidance. Let me just, a few more minutes. Let me see if there's any other,
Just to reiterate, if you were having sound issues, some of that may have just been whatever Wi-Fi you were on, because this is from GoToWebinar, but we're recording on a separate mic, so the recording will be of a different quality. And if anyone that is on this webcast, you're going to automatically receive that link as soon as it's posted on our website, and that should be within 5 business days. And it also sounds like some of you were not able to see the handouts that we posted there in your control panel. If you just open your control panel and open the handouts section, you can download the whole full-size PDF of this presentation. And then if you do have questions about specific slides, you can reach out to us.
Yeah, there is a plan versus no plan calculator on this website. So for those of you that want to take advantage of that calculator, it has not been programmed for this new deduction, but I think you can do some basic analysis with that. But yeah, we'll get back to you about whether or not we update our calculator for this.
Now some of you are telling us that the sound was great. I believe the biggest variable there is just your Wi-Fi or internet connection. So there's not a huge amount of control we have over that. And again, I see a lot of questions about entity type and how you take income, W-2 versus K-1, other types of income. Again, that's something you would need to discuss with an accountant.
Yeah. Okay, so again, I'm seeing very specific questions about people's own particular situation. So rather with only 1 minute left, we're going to do this. We have a few hundred questions. We're going to take the questions. We'll get, for those of you that shared with us your name, we'll go ahead and do our best to get back to everyone. Mm-hmm. I want to thank everyone for signing up for this presentation. I hope it was beneficial. Feel free to call if you're a Kravitz client, or feel free to call Kravitz anyway if you're not, and one of our Kravitz sales consultants can help.
Yeah, when I send out the link, I'm going to send you guys all a link to our what we call the territory map, so you can see who from which Kravitz team member covers your region, and that way you can connect with them and with our census partners as well, and really get into some more specifics about how our goal is to help you help your clients, and anything we can do in that realm, we're very, very happy to help you with. We cannot give CPE credit for this presentation, unfortunately, but we hope that it was nonetheless very valuable to you, and we are here to help however we can. We really greatly thank you again for your time and for your trust in us, and we wish you all a wonderful day.
Thanks, everybody.